let me get this straight. You're saying that you are in favor of Glass-Steagall, which breaks apart the two arms of banking, regular banking and commercial banking, except you don't want to break apart the two parts of banking. This is like something straight out of George Orwell.
I've never said we're in favor of breaking up the banks.
This is just bizarre. The idea that you can say we are in favor of Glass-Steagall but not breaking up the
We never said we were in
you.
favor of Glass-Steagall. We said we were in favor of a 21st century Glass-Steagall. It couldn't be clearer.
That was Treasury Secretary Steven Mnuchin testifying this past week in front of the Senate on Capitol Hill and having a bit of a back and forth there with Senator Elizabeth Warren about deregulation. And I am back with former Federal Reserve Chair Ben Bernanke talking about deregulation. Let's talk about Dodd-Frank and what you would like to see in terms of deregulation. Do you think that's necessary, and do you think this is welcome in terms of economic growth as well? Rolling back the regs.
It's always a good idea. It's always a good idea to look at the regulations. Of course, there are a lot of regulations out there. It's always a good idea to look at them and try to say, are they accomplishing what they're supposed to accomplish? How much cost, how much burden do they impose? Can we make them smarter? Can we repeal those regulations that are not carrying their weight, that have costs that are bigger than benefits? That being said, I think that it's very important that we not forget what a bad experience the financial crisis was and how much damage it did to our economy. And so a lot of things in Dodd-Frank have the purpose of making sure we don't have another situation like that. And I would think it's very, very important that as we try to reduce the regulatory burden, particularly on smaller and medium-sized institutions, which obviously did not contribute to the crisis nearly so much, that we not lose sight of the fact that we want to make sure that we don't have another financial crisis of the kind that we had just only now about 9 years ago.
Yeah. One of the issues bankers say is the fact that Dodd-Frank, some of the rulemaking, forced them to hold so much capital. And as a result, they stopped lending the way that they were lending. Do you see that happening, and do you see that loosening up?
No, I don't see that. First of all, capital is really the best way to make banks safe. If they have enough capital, first of all, they can absorb losses without failing or coming close to failing. And secondly, their incentives are better. If they're essentially, when they have capital, it means they're investing their own money, and so they're going to have incentives to do it better and to be safer. So I think having capital, adequate level of capital, is really very important. And one of the best things that happened to us here in the United States is that we've had our banks really get much better capitalized, and they're much safer and sounder than they were before the crisis. I mean, compare us to Europe, where they've had a lot more difficulty getting their banks back on a sound basis, and their economy is not doing that well. In terms of lending, I just don't think there's really any evidence, at least broadly speaking, that higher capital has impeded lending. Lending has been pretty solid. There are a few areas where it's taken some time. Mortgage lending, for example, was slow to start, and the standards are still pretty high for mortgage borrowers, but the housing sector is coming back and mortgage lending is coming back. Small business lending has always been a bit of a problem because large banks don't necessarily want to take the effort to make a loan to a corner pizza store or other small business. But generally speaking, overall lending has been very solid. It's grown faster than the economy, and I don't see any signs that high capital is choking off the economy.
So what would you like to see changed in Dodd-Frank then?
Well, again, I would start with the small and medium-sized institutions. The goal of Dodd-Frank was primarily to address the risks presented by the very largest institutions, and in many cases, the smallest institutions were kind of hit by, as a collateral damage from some of those changes. So that's clearly an area to look at. A number of regulators, including outgoing Fed Governor Dan Tarullo, have talked about problems with the Volcker Rule, which is intended to prevent banks from doing proprietary trading on their own account. But there are a lot of practical problems with that rule, and maybe there are ways to make that simpler. Maybe there are ways to make the stress testing of banks, which is a way of assessing how much capital they have, particularly during a really tough period. I think that's really important, but maybe there are ways to make that a little bit less onerous for banks. So I think there are a lot of ways and a lot of small rules and regulations that probably can be modified to reduce the cost.